Now, without further ado, I'd like to welcome our presenter for today, Mr. Jason Morrison, co-founder, executive vice president, and chief investment officer at SYGNUS Capital, who will be guiding us through the presentation this morning. Over to you, Jason.
Thanks, Damani. Good morning, everyone. And just one correction, my name is not Morrison Sir Damani. It's Jason Morris, Morris. Don't spoil up my good name, sir. Thank you.
My apologies, sir.
No big thing, man. No big thing. Nice icebreaker, right? So, good morning, everyone. Thanks for joining us. Just want to give you some inner workings of SCI's Q2 and 6 months financial results. So, as usual, we start out by giving you the backdrop behind the financial results. So, the dashboard for Q2/6 months, 6 main items that we want to highlight, a little bit different from perhaps the last several quarters, but we would have been hinting at this even at the AGM for those who were there, around the Puerto Rico business. So to start off, I want to say that the transformation of Accent is ongoing. They would have generated total investment income for the Q2 of 3.31 million US, up 62.5%. And that would have been driven by an expansion of the private credit business. If you recall, for those who are frequent here, or if you are new, Accent is a Puerto Rico private credit investment company that SCI would have acquired majority shareholders in. And it's operating in $100 billion economy in Puerto Rico. And so one of the reasons why this acquisition was made was to A, diversify SCI's revenue stream, but B, also to get substantial growth from what we saw at that time would have been a very fertile economy for private credit. And so far it's turning out that way. So total investment income was up 62.5% for the quarter. And that was, that component of that is net interest income, and net interest income for the quarter was actually up 44.5% to 2.39 million. So the business is effectively firing on all cylinders, so to speak. I think also that during the 6 month period and the quarter, Accent would have had substantial deployment of capital, which would not have been captured in the financial results as yet. Because obviously, if I deploy some money today, then it's gonna take roughly a full quarter for you to start seeing the full benefit of that deployment. So some of the close transactions that would have been deployed at the back end in December, we will see those results in upcoming period. So that translated into a 22.6% growth in net profit for the quarter to 1.82 million for Accent, and that's a new record as well. So the total investment income is a new record, and the net profit for the quarter is a new record. And in terms of SCI's investment in Accent, how we look at the return since the reorganization that would have taken place on July 1, 2023, that's giving SCI a positive 21.5% return on invested capital, which is a phenomenal rate of growth for a credit business. So that business is doing very well. And as we would have said, I think the last 2 quarters, but certainly the last quarter, we would have been hinting at the fact that, Accent would have been going through the process of finalizing its dividend payment policy, and then to start making dividend payments back to SCI. And this is how you know whether or not the business is really doing what it's saying, right? Because cash tells no lie. And so for the first time since SCI would have done the acquisition in November 2025, Accent would have paid for SCI 1.12 million in dividends. And this initial dividend payment will be done on an ongoing basis on a semi-annual frequency. So we can expect every 6 months for AccuSent to start making, depending on the net profit that's generated, obviously, dividends to to all the shareholders, including SCI. Obviously, SCI would have received 95.58% of the total dividend that was paid. So that's a fantastic news for SCI in terms of the return that SCI is generating and the cash that SCI is getting back from that investment. Fifth thing I want to highlight is that so SCI itself now would have had some temporary dislocation of net interest income, and I go through this in further slides. But effectively, dislocation of about 1.1 million US temporary dislocation for the 6 month period. Most of this occurred in the last quarter, primarily stemming from later recognition of interest income for private credit investment portfolio company whose investment we will be exiting in maybe the next 3 to 6 months time, and the manner in which we have to recognize the interest income has been kind of deferred, and that amounted to about 700,000. And then the remaining amount, of about 150 to 200,000 for the quarter, but 300 to 400K for the 6 month period has to do with the fact that SCI would have exited successfully 19.1 million US dollars in Q1, and as you know how private credit works, you have to redeploy the capital. So even if you were to redeploy all of the money in a very short time frame, it depends on the time at which you redeploy the money for it to start getting the full benefits of the deployment. So we are about, I would say that we have kind of redeployed all that money now, right? We have deployed about 11 million in the second quarter and 7 million subsequent to the end of the quarter. But obviously, if we get repaid cash and we're holding cash, it means that on the asset side of the balance sheet where we were earning, maybe 15-16% thereabouts, you are now earning cash rates until all the money has been redeployed. And then on top of that, we need to grow by deploying even more capital to grow the balance sheet. So that's a temporary dislocation and we expect to correct itself in short order. But yeah, and then finally, of course, we didn't take any new charge-offs. We didn't realize any new losses during the quarter or the 6 month period. However, as you'll see further on in the presentation, we actually got back some money from the one defaulted asset that we have on the balance sheet. We finally, we got back about 50 cents, 52 cents on the dollar as an initial payment for a $1 million investment that we had that was in default. And we expect that based on the final payment that we should get, as well as from other collateral that we have, that we should be made whole on our initial investment. But I'll get into that in the remainder of this slide. Now, into the financial performance of SCI. Total investment income was down 23.2% to 2.8 million versus 3.65 million for the similar period last year. And the reason for the drop off were twofold. I spoke about the net interest income temporary dislocation. So net interest income, right, for the quarter was down 295,000 versus 1.52 million last year. However, that was really driven by two temporary factors, which I highlighted on the previous slide, which was 700,000 in deferred interest recognition related to the investment I spoke about that we're exiting in another 3 to 6 months, and then between 150 to 200,000 due to timing differences from reinvesting the 19.5 million of exits. So on the one hand, we did a very good job to get back 19.5 million from our investments during the quarter. Very good. It shows that we're getting back money. We're not just deploying money, we're getting back money. But then, because the volume was so large, I think the single largest dollar value of investment existing in a single quarter in SCI's history, to my recollection. So obviously, timing difference between getting back that cash and the cash going back out the door to earn income. So that was the first part that affected total investment income, which was the net interest income part. And then the second part is the dividend that we spoke about. So that 1.12 million dividend that SCI from Puerto Rico would have paid to SCI as a dividend. Well, the accounting treatment for that, because Puerto Rico Credit Fund investment income is a revenue line item in SCI's financial statement, and as everyone on the call should know, if you are new, SCI is not totally consolidated up to SCI, right? So we have to do a valuation of the net profit that we get from that SCI makes each quarter, and therefore, once you get a dividend, that dividend is going to act as an offset against the equity that you own in the business. So effectively, the Puerto Rico Credit Fund investment income, the value that flows through SCI's income statement is exactly short by the amount of dividend that was allocated to SCI. So the dividend distribution of 1.12 million reduce the income, the PRCF investment income flowing through SCI's income statement. And obviously, because we're comparing, in 2024, there was no dividend, right? So ceteris paribus, we have for the first time a quarter in which we have an offset to PRCF when we didn't have any in the same period last year. Now, every time that SCI pays SCI a dividend, this issue will occur, right? But it will normalize, because going forward, every time that SCI pays SCI a dividend, the dividend is gonna, in and around ballpark. It's obviously we expect it to increase over time as the company continues to expand and grow and make more profit. But the point I want to make here is that this will normalize, because we'll be comparing periods, similar periods where you have an offset, and so this will kind of come out in the wash, so to speak. It won't have such a material impact on the financial results once you get to start comparing periods where there have been dividend offsets. So because it's the first time that is happening, obviously 1.2 million offset in this quarter versus not having any for the same similar period last year is a big difference, right? So if you take that, the dividend offset of 1.12 million, and then, call it 1 million from the net interest income temporary deferment and timing difference, you're looking at between 1.95 to 2 million for the December quarter in terms of effect and total investment income. So in other words, total investment income would have been closer to 4.8 million. So this has a domino effect on all of the financial results for SCI for the quarter. So net investment income down 50% to 1.29 million because of all of what I just said. And so would have been net profit as well, a loss of 527.8 thousand versus a profit of 203.8 thousand last year. And if you recall last year, I think during this earnings call, what I would have said then was the profit last year had jumped up substantially. And one of the reasons why that would have happened was because there was a huge fair value markup because of, I think, US elections and the outcome of who the winner was. And I had said at that time that we should, take the fair value gain, not on accuracy, but on the normal portfolio credit investment that SCI holds with a grain of salt, because this is a very volatile number that can go up and down. And true to form, that had actually happened. So this time what we are saying is the net profit figure is is abnormally lower than it would have been because of the two issues that I highlighted. But both issues we expect to normalize in Q3 heading into Q4. So as a result of all what I just said, earnings per share was a negative 0.09 US cents versus positive 0.04 US cents similar period last year. Dividends were paid during the quarter, and dividends paid were 0.0017 US dollars or 0.17 US cents, which amounted to $1 million US dollars versus 0.0028 US dollars or 0.28 US cents, which was 1.6 million for the same period last year. And one of the reasons why we would have paid a lower dividend, if you recall, we would have, during the financial year end results, would have stated that we had a portfolio company that was going through restructuring of its payment terms, and that restructuring wasn't really finalized. And so, out of an abundance of caution, we decided to kind of pay a lower dividend based on just what we viewed as uncertainty risk, so to speak, right? And if fast forward subsequent to that, Hurricane Melissa would have occurred pretty much right after that, right? So, well, Hurricane Melissa occurred at the end of October, and then we would have seen the effects of that in November. So as it turned out, the decision that we made, which was related to a different matter, turned out to be quite prudent, given all the outcome that we have from Melissa and the effect that marginally has on the portfolio. Just want to highlight something here. Well, I already spoke about Accusent's net profit growth and the fact that it generated net profit, and therefore, from a value perspective, the value of Accusent ceteris paribus should have been much higher flowing through the income statement, but it wasn't because of the dividend offset. And I'll get into Accusent financial results a little bit later. So moving to the 6 months. For the 6 month, total investment income was down 7.9% to 8.05 million versus 8.74 million for the similar period last year. Again, the same effect of what happened during the quarter would have also happened for the 6 month, right? But the 6 month results would have kind of held up better than the quarterly results. Why? Because the first quarter in the 6 month results was actually a record quarter. If you recall, I think we made 3 point something million. There, a record 3 million US, right? Plus. So for the quarter, interestingly, net interest income was actually a record. So for the 6 month period, despite the 1 million dislocation that we had in the last quarter, net interest income for the 6 month period was still up 14.1% to a record 4.7 million US versus 4.12 million last year. But you have to take this record net interest income into context, because we have record net interest income despite the fact that we have a dislocation of between 1 and 1 million US in net interest income. So net interest income would have been substantially higher for the 6 month period, right? Not for the dislocation that I spoke about in Q2. And of course, the dividend offset, since it happened in Q2, it would also affect the 6 month results. So total investment income was impacted by those two factors. Net investment income was 5.3 million, down 17.5% versus 6.42 million. And this is despite the 2.1 to 2.2 million dislocation that we spoke about. Net profit 2.65 million, down 48.3% versus 5.13 million last year. Earnings per share 0.461 cents. Versus 0.88, and dividends per share, spoke about that. For the 6 month period, Accusent actually delivered another record profit of 3.3 million, which was up 7.7%. And that was driven by a 39.9% growth in total investment income to 5.83 million. So that business is doing very well, growing very strongly, and justifies the reason why we did the acquisition and why from time to time we will seek to increase our stake in the business while we help it to grow and expand. It has a phenomenal team being led by James Connor and Raul. Now, just to highlight on this slide, summary operation results. I won't go through everything here. It's full of numbers. I just want to highlight. So just look at the areas that are circled in red, right? So you can see the net interest income that I'm speaking about, 1.52 million versus 1.8. And you will note that the interest income line, right, for the quarter for Q2, 4.975 versus 5.148. So what I'm saying is that if we didn't have this location, would have had a higher interest income and therefore a substantially higher net interest income. And then the Puerto Rico credit fund investment income is see where that is 1.168 versus 1.759 for the quarter, and similarly 3.078 versus 4.43. And what I'm saying is that those two figures, as you see on the Puerto Rico slide, when that comes up, would have been 1.12 million higher because the dividend act as an offset against effective that line item. And then if you go down further, maybe I can talk about fair value losses. So fair value would have been reflecting two things. One, there's normal movement, market interest rate movements, which went down and then they went up depending on how the economic scenario is playing out. Obviously, we now have hurricane to deal with for the Jamaican part of the portfolio, but also in the US, the forecast of rates being much lower faster is kind of wobbling, right? Because the US economy is doing fairly decent in terms of economic growth, and therefore the need to cut rates dramatically isn't there yet. But I suspect that before too long, that might change. So that's a changing argument all the time. Our expectation is that rates are gonna go down in 2026, one way or the other. So that would have impacted, as well as the fact that given that we had Melissa and we are assessing the performance of portfolio companies that are carried at fair value, then we would have marked down some of the business prospects for some of the companies. Obviously, when you have a natural disaster like that, you need to be prudent and revise some of your marks, and people would have also lost business, right? So business that you lose, you can't regain it. Obviously, as you go through time, the business can recover, and then you can always get back the cash flow in later periods. So when we see that rebound, then obviously these fair value assets can always also rebound, right? But for the time being, you have to prudently mark them down. Foreign exchange losses, as you all know, we don't own a foreign exchange business. We simply transact and we borrow mainly in Jamaican dollars and then deploy that capital into USD. And the currency has been doing a little bit of appreciation since the hurricane, obviously, because Jamaica had a record NIR before the hurricane, and then subsequent to the hurricane, Jamaica has access to billions of dollars of foreign currency, and therefore the currency has been appreciating on the back of that somewhat. So obviously because most of our, we have maybe 99% of our assets are in USD, but we have a large liability in Jamaica. So the currency depreciate is the liabilities that will get affected. So we have been gaining from depreciation in the currency. So now that is appreciating a little bit, you see that being reflected passing to the income statement. But this is something that we don't control. It moves up and down, and for the most part, only a part of it is realized, a small part. That is when we actually convert from J to USD to deploy. And then impairment allowance. I want to spend some time here. Impairment allowance of 776 versus 361 last year, which is 1.27 for the 6 months versus 414,000 for the same period last year. Would have been driven by two things. One, the initial, if you recall in Q1, we had actually said that we would have enhanced our modeling. We switched over to Moody's credit lens, which means that the way how we look at portfolio companies now automated and hard-coded based on their financial performance. And that would have changed some of the rating on some of the portfolio companies, which means that automatically you take additional ECL from those rating changes. And then two, and more importantly, was that we had a number of portfolio companies who we thought fit to restructure, renegotiate and restructure their payment terms. And once we enter in such a negotiation or discussion with a portfolio company, then their internal credit rating is going to change. So they move from like stage 1 to stage 2 based on IFRS accounting standards. And once we do that, then it means that automatically we have to use what you call lifetime expected credit loss, which simply means that the amount of expected credit loss that you have to book upfront is bigger than before. And so we would have had a 3 or 4 companies that would have fallen into this bucket of categorization, and therefore automatically it means that we have to provide for additional expected credit loss upfront. And if it turns out that the portfolio companies restructured payment terms work out and they don't run into additional difficulties and we get back our monies and exit, then the ECL that you carry is reversed. And so that's how expected credit loss works. So I wanted to give you insight on that as to what's driving that. And the third thing, obviously, because of Melissa, we would have made an initial assessment of the likely impact on portfolio companies. So, for example, portfolio companies in the hospitality industry, etc. Some of them don't have any cash flow, have substantially reduced cash flow for a couple of months, and people may file insurance claims, start to get additional capital, get their business up and running again, and then to normalize the business. Obviously, this takes a time, right? So during the period when you're doing all of that, and we may need to provide support to set portfolio companies in one shape, form, or the other, then obviously we have to take additional expected credit loss charge for those portfolio companies. And I'll have some more information on that in another slide. So that's what's driving the impairment allowance there. So I just wanted to give you additional insight on the face of the income statement in terms of how we share this information in terms of the results of operations. So I'm going to speed through the next couple of slides to catch up back on the time. So this slide is showing you AccuSense's first dividend to SCI. So the start, read this slide from the ground up. So at the bottom of the slide, you have AccuSense Financial LLC, and the net profit for the company was actually 4.77 million US. I think, and this is the audited financial statements. I think when we reported this earlier, we had a slightly lower number of maybe 4.3 million or thereabouts, but the finalized audited results are 4.77 million. So as a result of that, dividends declared were 1.18 million. And because SCI owns 95.58%, when you scale it all the way up through the holding companies, then the net money that SCI would have received is 1.01 million when you take out fees and taxes, right? So this is great. What it shows that getting repatriation of cash from your investment is always a good thing, and obviously this is very positive for shareholders for more than one reason in the future. Next slide is showing you AccuSense Q2 financial results. And as usual, for those who are usual here, or if you're new, you read the slide from the bottom up. Don't worry about that the information may seem a bit confusing. It's very simple. All you're focusing on is the second column for the current period. The first column is giving you the different holding companies. So AccuSense is at the bottom, and it's 100% owned by SYGNUS Credit Puerto Rico Fund, which is a holdco that we use to acquire AccuSense. And then we have another company called SYGNUS Credit Investments Puerto Rico Inc., SCI PRI, that is the one that owns the 95.58%, that then flows into SCI. So AccuSense made 1.82 million for the Q2 December quarter versus the 1.48 million last year. That flows up into the holdco at 1.72 million. Obviously, the holdco has small operating expenses in there to keep it floating. But then this figure is no longer consolidated. You have to do a fair market valuation of it by applying multiples, market multiples based on similar companies that are publicly listed in US and Canadian exchanges, and apply a discount to that. And that figure, as you can see, gave you 1.17 million, right? But the real figure that it would have given me was 2.29 million. So when you subtract 1.12 from 2.29, it gives you 1.17. And just to give people insight, if you weren't on the last call, to get from 1.82 to 2.29, it depends on the market multiples, right? Because effectively, this is basically saying what's the value of the cash flow stream if you were to sell it to somebody else. And obviously, it's not, you wouldn't be selling it at what the actual net profit is, right? As you can see, last year, the 1.48 million would have translated into 1.76, but this value can fluctuate. So in previous periods, we'd have had a quarter where the company made $1 million and we registered a loss flowing through SCI. So it depends, but things have been normalizing and we have a pretty normalized figure at the current time. So if you look at the 6-month results, for Accent, read the same way, the 3.3 million, right, in net profit would have flowed up to the whole core at 3.1, and then that became actually 3.08 million flowing through SCI's income statement, which in the form of SYGNUS Credit Puerto Rico investment income, right? But this figure was actually 4.2 million. So when you subtract the 1.12 million from 4.2, that's how you get 3.08. And as you see last year, it would have been 3.07 million that the company would have delivered in net profit, but that 3.07 million resulted in 4.43 million in terms of the value flowing through SCI. So once we get to say next year this time, right, we're gonna have like for like, because we're gonna have a period where there's an offset, and the difference between the offset isn't going to be that big, right? It's big now because $1 million versus 0 is a big number. So I'm saying that you know, this will normalize, and it's a good thing that's happening. It's just that it affects your financial statements temporarily, but it will normalize. So speeding through, efficiency ratio, we came well within the threshold level, which is, you know, the dollar value of revenues that goes out to pay operating expenses. We want to keep that below 40%, which is kind of a best in class threshold for private credit firms, and we were well within that at 34.2%. And then management expense ratio, and then we promise shareholders to keep that below 2.85%. You can see that we are well within that at 2.4%. For the balance sheet, shareholders equity was slightly down, marginally down 1.1% to 74.82 million, still very healthy. If you adjust that for perpetual preference shares, you're talking about a company with 107.6 million US dollars in effectively equity capital, right? And total assets increased 4.7% to 228.13 million. Now, we did a number of things during the last quarter and for the 6-month period, right? We would have raised 19.26 million in capital during the period, which is a pretty decent raise from private markets, of course, not publicly. And then would have prepaid 7.91 million in notes. So, you know, SCI from time to time will issue notes in the private market, and we would have prepaid some of those notes. So notes were maturing, and we just paid them off before time. And by paying them ahead of time, what that did is save us on interest expense, right? And of course, investors would have been happy. Well, it depends on what type of investor you are. We paid them in advance. I think if memory serves, I think we kind of had to top them up and make them whole. But we prepaid those $7.9 million, 191, and then would have repaid our credit lines up to the tune of 6.29 million. Again, it's important to consistently prove that you have enough cash flow generated from the business to pay out your liabilities. So we paid 6.29 million in revolving bank credit line. Of course, those revolving bank credit lines are available for us to draw on, which we are in the act of drawing on to fund transactions that we have in the pipeline, right? And then the other thing that we did, which would have occurred during Q1, but the effect of it took place in December, which is we had 26.99 million US dollars of preference shares that were slated, well, matured or were slated to mature in December 2025, and we would have negotiated with preference shareholders from the September quarter to extend those preference shares by 3 years at lower interest rates, which is a great thing. So both JDollar and US dollar preference shares would have had some cost savings at that, because we would have extended the tenor by 3 years and negotiated better credit terms. So that's a good thing. Balance sheet. Every time I have to mention this slide that SCI is a very lowly levered company. So whether you measure debt to total assets, that 0.23 times, and we have a threshold limit of 0.5 times that we don't want to ever go above, or if we go above it, it should be very temporary. Asset coverage ratio, we are 3.65 times, up from 2.5 times similar period last year. Why is this important? Basically, it's just saying what's the value of assets that we have on the balance sheet that we can quickly convert to cash to pay off near-term maturing debt. So the bigger the number, the better it is. And then net debt to equity, we have a limit of 2 times, and our target is actually 1.25 times, right? So ideally, we want to be at 1.25 times, which is to utilize debt such that we can optimize and maximize the amount of returns that we generate for shareholders. And currently, we are at 0.5 times, which again means that we have very low leverage. And what this means is that if we go through a very bad economic scenario, then SCI has a lot of flexibility, because we can take on a lot more debt, or we can take on a lot more financing. It won't overburden us, because we are not like levered up 5 times or 7 times or 10 times, right? We have very, very low leverage, which means that we can take on many, many opportunities to grow. And then non-performing investments were at 0.4%. Knock on wood, we hope to keep that at a lower ratio versus the 5% threshold that we have. Now, looking at investment activity, investment in portfolio companies, 207 million versus 206 million for the similar period last year. Again, by now you would have figured out why this is. The reason why the number hasn't moved, obviously, because we exited, like I said, 20 million during the 6-month period, with 19.6 of that coming in one single quarter, right? So once we have redeployed our capital, then you will see the value of the portfolio grow significantly. Number of investments increased to 41 versus 37. New investment commitments during the quarter, 11.88 million. And we would have done about 7.5 to 8 million subsequent to the end of the quarter. So as of right now that I'm speaking, we would have redeployed out that 20 million that would have exited. Portfolio yield 14.9 versus 15.2. Again, this fell because the assets that would have exited would have been high yielding assets. And we expect that as we go through time, the yield on this will probably fall a little bit further based on just where we are across the Caribbean. Average tenor 1.3 years versus 1.6. Again, SCI is our average tenor of investments, even though what we normally look for is 5-year investments, but based on the type of transaction that we're funding, if you're bridging acquisitions, etc., those are going to be short-term, but relatively shorter tenor investments. Dry powder on the balance sheet was 7.95 million as at the end of the quarter, December. And we also would have had 7.2 million in undrawn credit lines. So we had a decent amount of money, cash, which is why I said before, investment in portfolio companies did not really grow, right? But in addition to that, we are actually closing the first of two international financing transactions. So we're waiting on one CP to close and announce the first deal, and the second one, which we were waiting on a license that we needed to get, and we got that license I think in late January, and so we are moving full speed ahead to execute with our international financing partner, which I speak to in the outlook section. So Accrescent, and we have 20. So I say all of that to say that we have 25 million in approved deals that we are actually going through various stages of documentation to disperse. So we're not short of transactions, and for the time being, we're not short of cash, but we're gonna need more cash for sure. Accrescent actually deployed 41.27 million over the 6-month period, which is phenomenal. Most of that came in the last quarter. A lot of that came in the last quarter, so we're not seeing the full economic benefit of that. Will be seen, in quarters to come. And I spoke about the portfolio growth and where it is, and you can see that Accrescent is chasing down SCI in terms of size of portfolio. So SCI will have to fight to defend its turf in terms of which book is larger. Speeding through to Hurricane Melissa update, portfolio value of, this is an ongoing assessment. So far we have 20.1 million that would call high impact from the hurricane. These are companies that obviously got hit in a bad way, which means that they would have lost revenue, have to claim insurance, have to do refurbishing, rebuild the business, or don't have access to workers to come to work, the whole 9 yards, right? And this would have been in distribution, hospitality, manufacturing, and more than one services industry in terms, including telecommunication. So we are working with those portfolio companies, provide whatever assistance we can, breathing room that they need, because ultimately we have to build back stronger, and that's what private credit was designed to do, right? So we are working with those portfolio companies. So as a percentage of SCI's portfolio, this value represents 11.9%. As a percentage of the overall private credit book, if you include the fact that SCI owns 95.58% of Accrescent, and Accrescent has 130 million in portfolio value, and you add that to SCI's portfolio value, then it's 7.2% of the portfolio is actually affected by Melissa. So we continue to monitor and work with portfolio companies as appropriate. From a risk management perspective, looking at the balance sheet ECL charge, so just for brevity, the expected credit loss that you see in the P&L is actually the change of the balance sheet ECL. So we are looking at the ECL and how it has changed over time, and you are seeing where the ECL on the balance sheet has been increasing, and it would have been increasing, reflecting what I said earlier, which was we have a number of portfolio companies that we are working with to restructure their payment terms, and once you determine to change or restructure the payment terms, then you have to reclassify the portfolio company, and therefore you have to take additional upfront expected credit losses. So this will increase your ECL automatically. And then of course we also have the Melissa assessment, which we are constantly updating every month in our monthly risk meeting, where we look at the portfolio companies, look at the reports that we get from the company, discussion that we have with their CFOs, CEOs, MDs, etc., and then as appropriate adjust the ECL to reflect the current environment. And even though obviously Jamaica is recovering from the hurricane, it's still a long way to go for some of these portfolio companies. So the combination of those things is what is pushing up the balance sheet ECL. In terms of recovery, we received $529.1 thousand US from an original investment of $1 million for the one defaulted company we have on the balance sheet. It was 2 before, and we know we only have 1. And so this is a good thing. Our carrying value of this is about, so we have a remaining 600 plus thousand of carrying value, and we expect to get back all of that money from a combination of the second settlement that we expect from the estate, as well as the collateral that we have, which far exceeds which far exceeds the value of our investment. So we expect 100% recovery on this, and as we get more information, we can provide it to you. But we have been saying for a very long time that we expected to be made whole. So finally, we have gotten that first initial settlement. Hopefully, the second settlement comes big in short order. So from an annualized loss rate in terms of how much money we have crystallized our losses since inception and 370 million of capital deployed, which does not include Puerto Rico, is 0.2% annualized loss rate. Puerto Rico's annualized loss rate is actually lower than this. I think it's 0.13 or something like that. They have been a phenomenal in terms of managing crystallized losses. So speeding through the rest of the presentation, allocation by industry, as you can see, SCI has a wide and varied allocation right across multiple industries, right? So I won't spend much time here. Nothing much has changed from this quarter, last quarter to this quarter. And in terms of allocation per region, Puerto Rico still is majority allocation at 39.4 versus Jamaica 24.2. And this is going to be a race because Puerto Rico is growing very fast. And so, you know, the other economies we have to play with. I know that Jamaica is gonna play a significant role given the reconstruction effort and rebuilding effort that SCI has already been a part of in terms of providing capital to the numerous opportunities that has come our way, some of them for critical infrastructure to rebuild and reconnect the western part of the island. So we're happy to be providing playing our part to help rebuild Jamaica stronger. And final slide, strategy. The first one dealing with the Puerto Rico business. Actually, the Puerto Rico team deployed a record $100 million for calendar year 2025, right? And this includes obviously Accrescent because they have more than one portfolio company. SCI is invested in 2 of them, but Accrescent is the one that really gives the big bang for the time being. So 100 million deployment in a single 12-month period is a monumental achievement, and that just speaks volume to the type of business that exists in the Puerto Rico market. Of course, we'll be looking to not just grow and dominate the market in Puerto Rico, but to look elsewhere for expansion opportunities at the appropriate time, right? The business is doing records on every single level, whether you look at net interest income, total investment income, net profit, portfolio growth, etc. So obviously, our job is to raise new capital, including for the business, which it also includes SCI putting more money in the business to support and grow it. Because if you're getting 20% return on your equity investment and invested capital, that's always a fantastic thing to do, right? And then look for expansion opportunities, which we are actively doing. And then, of course, first dividend paid is a sizable dividend, 1.12 million. So you can expect that this dividend will only increase over time as the business grows, right? On a semi-annual schedule. So this is exceptionally good news, I think, for how that business is going and the quality of the management team. So Puerto Rico, just keep doing what we are doing and grow it bigger. That's the story there. For SCI, we have set a core revenue target of 12.5 million, which hasn't been revised yet, but obviously last year we hit 15 million, and we expect that this year we should exceed that, well, get up to there or thereabouts again, right? But 12 million was the threshold, and we're at 8 million half year. Obviously, we're on track to beat that target. We have 25 million in approved transactions, in addition to the 7 million that we have deployed subsequent to the end of the quarter. And the pipeline obviously has, I don't even know what the pipeline is at this moment. Obviously, we have to be very careful in terms of being very deliberate about what we deploy capital in, but fair to say that Jamaica in particular, there are just a huge amount of opportunities. ROE needs to be above 10%. It's in progress. We're at 7% for the 6 months because of the dislocation. We expect that things will normalize, set the risk variables, all other things being equal. EPS, we need to grow that at 20% per year. At the moment, we are currently failing because we are down 47.7%, right? But what I would say is that perhaps this year's quality of earnings is getting better and better, especially with what's happening with Puerto Rico. So we hope to turn it around. Dividends need to be above 5%. Again, we are below that currently because of the 1 million that we paid in dividends. By the way, the board of directors will meet, I think, remember the date, we'll meet shortly to consider a dividend based on the 6-month results. So you can look forward to that as well. Dry powder of 100 million. I spoke about transaction that's closing, first financing, and we're looking at others, and then the sponsor business partnership. We received the license, and so we're executing with that international partner. Third thing, managed portfolio risk. I kind of spoke about this earlier, but we don't want to gloss over it. All the stage 2 portfolio companies, we have to restructure the payment terms, work with them, monitor them, and manage the exit at the back end, because that's what it's all about. Post-hurricane monetary risk, continued assessment of the Jamaican economy and financial health of the economy, and then obviously the industry within which these portfolio companies pay, and then of course the portfolio companies themselves, what is their health. And then stage 3, the one portfolio company, just to get back all of our investment, which we are on track to doing. And then finally, share buyback. We haven't bought back any shares in a while, and I think the program is coming up for renewal. So our job is to get that program renewed at the appropriate time, and at the appropriate time, buy back shares. Thank you very much for your patience. It's a bit long, but I needed to spend the time so you can get a fulsome appreciation of the dynamics of SCI. Thank you.
Okay. Thank you very much, Jason, for that very detailed walkthrough. I'm sure listeners and investors alike appreciate all the clarity that you've brought to SCI's performance and the trajectory of the business. Now we'll move on to the usual question and answers segment. Just a reminder to ask your questions using the Q&A option in the Teams chat. I'm seeing a lot of questions from YouTube. So please, those of you on Teams, be sure to ask your questions via the question and answer option. All right, so just to jump straight in, I'll ask some of these YouTube questions. Some very good questions coming from the YouTube chat this time. So Afra-Exim provided a US 100 million facility to a company in the Bahamas Striping Group of companies. And given SCI is pushing the Bahamas, this is a lost opportunity. And if SCI had the large revolving facilities that they have been seeking, they could have supported that company. And I suppose the question is, or rather, the person is looking for comment on, that deal and also updates on the large revolving facilities.
Yeah, so excellent observation and question. So this is probably public knowledge, right? Well, maybe it's not. So the way we look at Afra-Exim is that they are actually validating what we have been doing in Bahamas for the past 5+ years, right? So we have funded over 70 odd million or more in transactions in the Bahamas. So they are just validating that. That's the first point. Second point is we can coexist, right? We don't view it as a lost opportunity per se because we don't have 100 million to give to one single portfolio company, right? And I guess the second point there is that we actually, well, this must be public knowledge. It's public knowledge. We actually finance that same portfolio company, and we have relationships with that same portfolio company, and we continue to fund projects for the same portfolio company. So the more them getting that 100 million is great because it just means expanded opportunities. So we will still do transactions, and we have multiple other such transactions within the country. So I understand the question, but we don't look at it as a lost opportunity because it didn't stop us from financing transactions for the company, and it won't stop us from doing so right now as we speak and going forward, because the opportunities are so numerous. And by Afro Exim coming in, they are saying yes, you know. So in a perverse way, the Afro Exim deal there might actually help us, right? Because remember that we are trying to, we have been saying that we want a big credit line or big financing line to do multiple things because we don't have enough capital. So we are close to the situation, and we understand, and let me say that we are close to the situation and understand Afro Exim coming in and how that might actually be very beneficial to us, because it's a DFI, development finance institution, that's coming in and saying yes, this thing actually in this market actually is very good. So that's how we look at it, and that's how it's actually playing out for us in reality. And when I can say more than that, I would say more than that. Obviously, we are, as I said before, we are seeking financing from multiple partners, and we were waiting on a business license which we received. And so, you know, in short order, you will hear additional information about what we are doing and expansion and our expansion within the English-speaking Caribbean. So we view Afro Exim as a very good entrant to validate what we have been doing, which maybe without Afro Exim going in might not have been construed as a big enough or robust enough thing to do our market. So we're happy actually that this has happened.
Okay, thanks for that answer, Jason. The follow-up question, which you actually just hinted at, but I will perhaps allow you to answer it again, just so that investor has, you know, the clear picture. There was talk of a new business venture revenue line item to come. What is the update on that, and where can we learn more about what it is?
Well, you can learn more about what it is once it's been formally launched, which should be, we are going through the execution phase. We were doing some background work. We are now going through the execution phase. Companies already registered, etc. And now we are going through the normal thing that you do when you have a new business, right? You need to put in the operations piece to ensure that once you start, then you know, you can just take off running. So that's what we are doing, and we are working with an international financing partner who will be providing the first set of funding and then we will expand that funding base. And we hope that we can do this, the growth of that business, ramp it up very fast, given our expertise in the area. So there's no way for you to go and learn about any more about it until when we feel comfortable to release the information. As you know, you need to work in silence, right? And then when you have something concrete, then that's when you make noise. Or let the concrete thing that you have make noise for itself.
Thanks for that, Jason. Okay, two hard-hitting questions here. So the first one is, why hasn't the dividend yield target of 5% at APO price increased since you have hit the target several quarters ago?
Good question. So I actually hinted at that during the presentation, but happy to answer it more clearly. So as I said before, at the end of the financial year last year in June, so in September when we had earnings, when we had the earnings call for the financial year end, we would have stated that we changed our risk model to credit lens, Moody's credit lens, with an international best practice off the shelf, which Puerto Rico had been using for quite a while. So we migrated the rest SCI formally to it. That increased our ECL, and then we had a large company that presented a restructuring plan, and that restructuring plan would have caused, if you look at the audited financials, you see that the ECL that we carried there was 3.6 million or thereabouts, and the majority of that would have been due to one single portfolio investment. And so because that stage 2 restructuring exercise, or that restructuring exercise led to the reclassification from stage 1 to stage 2, and there were uncertainties around how that will execute and unfold, then obviously that would have, we took the early upfront ECL charge, and basically now need to wait until everything has been finalized. I'm happy to say that things have advanced substantially, but they are not they're like 90-something%, they're not 100% there yet. So we felt it prudent enough that based on the reduced earnings that would have reported in the financial year, that 1 million would have been the appropriate dividend versus 1.6. So it would have been above the 5% if we had paid another 1.6 million dividend. So it's just out of an abundance of caution to say, well, we are managers of risk, and if we have, additional expected credit loss so substantive, then we can't, well, we shouldn't, in my view, pay a $1.6 million dividend, which would be consistent with everything being hunky-dory, because that's the dividend that we have been paying for like 3 or 4 quarters in a row when everything was hunky-dory, right? And so that's the reason why we reduced the dividend from 1.6 to 1. But at the same, and then if you fast forward now, we actually have Hurricane Melissa that happened in Jamaica, that, basically we have 24% of our portfolio is Jamaica as a quarter, and there are, quite a decent number of companies that got hurt, and got hurt bad in some instances. Obviously, the companies are, restructuring and, rebounding and so forth, but it's going to take a time. And so, if you combine that with all the stage 2 companies that we have, which means that we are taking additional expected credit loss, we wouldn't be prudent if we continue paying the same level of dividend as if nothing has happened to the portfolio. I mean, our expectation is that, okay, we will get through this period, just like, when we were in COVID, we got through the COVID period, but we have to be prudent because you don't know if we're 100% sure. So effectively, the reason why our APO dividend yield is where it is because we paid 1 million in dividends at 1.6, And the lower dividend paid, we view that as a temporary lower dividend. And the reason why that temporary lower dividend is very obvious. We have a very big, Puerto Rico is almost going to be 50% of the book in short order based on the pace of their deployment. Their business is firing and they are paying cash back to SCI. So ceteris paribus, if once things normalize, obviously, one could even say that in over a little horizon, the dividend from Puerto Rico by itself, for example, right, could get the yield and the APO price to be above 5%, right? If you extrapolate. So I'm just begging for patience from shareholders on that. I mean, we have to be prudent. And what we want to do is prudently pay the amount of dividend that fits with the rationale of where the company is. And at the end of the day, if things rebound faster than what we are currently anticipating, then the dividend will just grow faster and higher. And now at least everybody knows that given Puerto Rico start to pay dividends, that our claim that we want to keep the generate a dividend yield that is very high is real, right? Because we are showing that we have another source that can now pay cash, which can obviously just flow directly from one source to the other. So just a little bit of patience. We'll get there, but we are going through a little bit of a period. And with what I said happening in Q2, again, those are some little other wobbles that we prefer to keep reserve the dividend payment, and then once we see the coast clear, then the dividend gets increased to beyond the 1.6 that it was before semi-annually, which was I guess 3.2 million run rate. It was obviously the dividend is headed ceteris paribus substantially higher than 3.2 million once all of what I've said in terms of the plans that SCI has works out.
Okay, thank you for that, Jason. Take one more from YouTube. So for the period, profits are down and the dividend is lower, and there have been no buybacks this year or since last year. However, management fees are up. Could you commit to executing some share buybacks this year? And will all dividends from PR be paid out to SCI shareholders?
So let me answer the last question first. All dividends from PR are being paid out to SCI shareholders. That depends, right? I mean, that depends. So, but for the most part, yeah, the dividend is being paid. Will be used to fund the dividends to shareholders. But I don't want people to think that okay, if it pays, if it pays $1, that means we are gonna pay all of the dividend to shareholders. That's not necessarily the case. That's not how business work. But there's nothing stopping us from doing so. So that's one. And then there was a comment about management fees are up, so versus profit is down. So again, remember that management fees are calculated based on assets under management, right? So and it's management fees are and it's a monthly calculation. So if assets under management increase from 10 to 20 to 30 and then it dropped to 10, right? That would be 4 different months. And so the question is, when you started out, when you had 10 and then you had 20, 30. Those months when you had the 20 and the 30, if you add up all of those management fees, and then you're comparing to the period where the management fee dropped to 10, obviously the management fee would be higher, right? Because your AUM actually grew until it fell. But the time period over which the AUM fell wasn't substantial enough to offset the higher management fee from the higher AUM periods. That's one. And two, net profit is down, but we explained why net profit was down. It's a combination of the deferred recognition as well as the offset for the dividend, and the fact that, like I said last year, this time in the earnings call, I did make to say that the level of profitability, which actually would have jumped out aggressively, I think from the first quarter, the profit figure was like 5 million, which clearly I said at the time was too far, too fast, which it turned out to be in the end. So the way we look at the business, right, is that we have paid out, I don't know, almost a quarter of share capital as dividends, and we haven't missed a dividend payment since inception, even though during the worst crisis certainly in our lifetime, when everybody else, most other people didn't pay dividends. So I think that management has certainly, you have to give management a little, you have to give us a little bit of kudos for the job that we have done so far. Granted, you are shareholders of your company, but our philosophy is to get the company back on the track of the dividend yield being above the 5% APO yield. And we have shown you, and we have been telling you well in advance. It's about 18 months now I've been talking about Puerto Rico business and how it's going to expand and what it means. And when that time comes, when the dividend from Puerto Rico will start getting paid, and the proof of the pudding would be in the eating in terms of the dividend from Puerto Rico. And now you've seen it coming to fruition. So I'm also saying that on a go-forward basis, dividends, ceteris paribus, all our things being, knock on wood, dividends will be substantially higher than they are today. And then the third point is around buyback. So yes, we did buy back any shares last financial year, but you can understand why. I kind of gave all the reasons why we did buy back shares then. We really don't have enough cash to go and buy back shares versus deploy the capital where we see fit, right? Certainly for this year, we'll be seeking to, at the appropriate time, buy back shares. But share buyback is a function of many things, and it's also a function of liquidity and opportunity. And the opportunity can be there, but the liquidity simply isn't, because the liquidity needs to be more properly channeled into areas that it has the biggest impact. So that's how I have to answer that question. But the buyback isn't going anywhere, right? It's when it expires, gonna get renewed, and then it's a mechanism that we want to maintain because we believe in the strategy of SCI and where SCI is headed. As I've clearly outlined where it's headed in terms of expansion plans to grow the platform, to get it much, much bigger so that it can deliver substantial dividend payments. And just for context, public listed private credit firms in the US, their dividend deals are like, twice what SCI is. So that's the gold standard, and that's what we are aiming for ultimately. But it doesn't happen overnight. We have to do it prudently in a manner that is sustainable.
Thank you for that, Jason. So I'll go over to the team chat for a minute for some of the questions here. I see some very good questions. from Mr. David Rose as usual. So first question would be, is the current revaluation of the JMD USD currency pair to 157 JMD to $1 going to translate to a wider FX loss in Q3 2026?
Well, I don't know what will happen in Q3 2026 because I don't know where the currency going. I mean, it has appreciated to that level now, but it could as quickly reverse, right? So the story is, once it appreciates, it's going to be an FX, record as an FX loss. If it depreciates, it's a gain. And this is how it has been from SCI. Decided that we would not fund a lot of J dollar assets. We will fund USD assets only, and we'll borrow in J and fund USD, which has worked beautifully for us over several years. So, I mean, ultimately, when Jamaica starts to build back properly, we're going to have to import a lot of stuff. So I expect the currency to go up and down, right? It will fluctuate. Currency has been trading with a band, and that band kind of widened out pre-Melissa, and so it just ratcheting back to the lower side of the band now. But we don't really watch that. We just do what we have to do, deliver value, and in any event, based on the scale of SCI and where SCI heading, we don't expect FX to be a big, massive issue for SCI. But good question. But if it continues to appreciate, certainly you're gonna see an expansion of FX losses, unrealized. And if it shifts back in whichever direction, the opposite happens. But we don't try to do anything with that. We leave that alone because we don't think it's material to SCI's financial prospects, in a sense. If we think it is, then we'll take action. But at the moment, we think it's a beautiful thing to borrow in J and invest in USD. For the most part.
Thanks for that, Jason. For this next question, I know we spoke a bit about the pipeline of approved deals, but perhaps maybe go a bit further into the origination pipeline. But the question is actually, what is your expectation on demand or deal flow in 2026 based on the Hurricane Melissa impact?
Good question. So, I mean, I think from last quarter, I said that we were seeing very early signs of massive demand, and I don't think we haven't. So, obviously, we don't have enough money to fund all the demand that we are seeing, because we have to help existing portfolio companies to recover stronger, right? And there are relationships that we have, companies that we would have invested in 2-3 years ago. They paid back all our money, and now based on what happened with the hurricane, they come and say, listen, I want you to do XYZ, right? And there are companies that are in the backbone of like connectivity across the island. There are companies that are in energy space. There are many companies in the food distribution space, right? Obviously, if you have a food distribution business, more than likely you have to rebuild the facility. You have to help your workers them get on their feet. You have to put in probably additional infrastructure, because maybe before you didn't have solar, and you say, okay, I need to put some solar as part of my energy mix, and then you have to restock your inventory and reopen your windows, and then reconnect with those supplier contracts, right? And obviously there are also people who, from a receivables point of view, they need substantially longer lead time, so receivables financing, and that. So they are just like a plethora of financing opportunities that are coming across our desk every day. And obviously our job is to pick, choose, and refuse, right? To ensure that we get the best bang for the buck, so to speak. But absolutely, we are seeing huge demand. And one of our financing, well, the facility that we are closing now, in terms of financing to SCI, actually is a dedicated facility for Jamaica. So hopefully we can close that very fast and deploy that capital very fast, just to Jamaican companies only, because we are seeing the economic activity on the ground is strong. Meaning Jamaican economy obviously is holding up well, but you need a lot of capital. You need a lot of capital from anywhere capital can come from to help to get the economy back in good shape. So we are playing our part in that. So to answer the question, I can't put a number on it because it's not every single deal that come across our desk we're gonna fund. But we are seeing maybe 100 million in transaction that we would fund. But obviously we can't fund 100 million because we don't have 100 million. So, and that's just what we are seeing. So I can't just imagine what we are not seeing.
Okay, thanks for that, Jason. And just to go back a little bit in terms of the share buyback program, see a lot of questions from investors in relation to our share buyback strategy. So I will just ask, I guess, a two-part question from actually two different investors, just because I believe investors really want some clarity on the strategy going forward. And so those questions are, one, in terms of the refresh of the program, will that refresh be based on the amount not deployed thus far from the previously stated program size, or will the whole program size be refreshed? And two, in terms of sort of the pause in share buybacks thus far, and given the reduction in dividend, what is your opinion on how that affects the stock price? In other words, do you believe that that will cause the stock price to be depressed? And what is your strategy to manage that going forward?
Good question. I mean, in terms of stock price, to be honest, when we were buying back shares, we didn't see the effect on the stock price in terms of it being like consistent. If we buy back shares today, the stock price run up and then it just goes back down. It's like when dividends are being paid, the stock price run up before dividend and then it drop off after, right? And so from my perspective, share buyback doesn't have a, my view is that it's not having a longevity. Whatever action happens, it doesn't last, right? And so I'm not so much focused on using share buyback to prop up stock price. I'm more, okay, our job is to say we need to deliver earnings of $1.20, $1.50. I mean, 1.20 or 1.50 US cents, right? Which would be like, okay, let's keep doubling, which is why we have a target of 20% per year growth in EPS, right? If I grow EPS 20% per year, then we get up to the 1.5, let's say, or 2 US cents. Then if my EPS is 152 and somebody is doing a PE multiple, then clearly what's gonna start happening is the earnings of the firm relative to the price is gonna become ridiculously cheap. And then number two, because the dividends are actually increasing, so based on our strategy, we launch a new business, we get these additional financing facility, and so SCI is making more money, and obviously Puerto Rico is making more money, and Puerto Rico probably catch up to SCI and it is at 200 million in AUM, right? And now it's making instead of making 4.47 million in profit, which it did last year, is now making closer to 10 million in profit. And then the question is, well, what's the dividend that will kick off to SCI, right? Because if you're making 10 million in profit and you do, even say in steady state, in most conservative steady state, you say you're going to pay 40% of that in dividends. That's like $4 million per year, right? $2 million every 6 months. So when I look at it, if I look at it from that perspective and say that's our fundamental job, and don't worry about short-term gyration in if I buy back the shares, the stock price go up or go down, and I'm worried about it that much, right? Then if I do that, if I do those two things, which is to grow the EPS, and in turn grow the dividend, because Puerto Rico is doing lights out business and SCI doing lights out business, then that will force the stock price to multiples higher than where it is today. And so that's the strategy. That's it. That's the strategic direction in which we are headed, right? And not trying to say, well, I want the stock price to double from 6 cents to 12 cents or to triple to 18 cents, and so I'm going to buy back X amount of share. So that's how I answer that part of the question. In terms of the refresh of the program, I think the program will be refreshed probably with what was remaining, which is still a big figure, right? Because I think it was a 9 million buyback, and we probably bought back 1.2, I don't remember, 1 point something or 2 million. So I think the refresh will refresh that way. But I'm saying that for me, the job is create an investment vehicle, SCI, that you can go and buy the shares any day and use it for your college investment fund, because you know that you will pay consistent dividends yielding X or Y. And when you look at the alternatives in the market, you can't get that level of consistent dividend distribution. That's our philosophy for SCI. That's what we want SCI to be. So, you know, you look at that bond and say, okay, I can buy this bond, or you can buy whatever. Okay, you can also buy SCI because it's giving you higher than or competing bond interest, which is exactly what private credit companies globally do, right? They are literally, investors look at them as like literal income investment. And obviously, because the stock price is so low, for those who, you know, buy it at what I'm going to call cheap level, then when that day comes, you have the best of both worlds. You have decent cap gains because your entry price is relatively low, and then you have a fat dividend. That's the objective that we are pushing for, which is why we are so deliberate about our strategy of communicating well in advance. When we have challenges, we communicate with challenges. Then, when there are good things, we communicate the good things, so that, you know, we're not. This SCI needs to outlive all of the current management, and, you know, forward to the next generation at whatever time, so it become a staple. So that's what we're trying to do, and that's how we look at the share price. And I understand why the question is being asked that way, but I'm giving you honest feedback as how I look at it. And anything we do with share buyback, I think is gonna, the effect of it, based on just shareholder attitude, is gonna be, I think it's gonna be temporary. I think the permanent transition to a higher sustained stock price is we deliver EPS growth that then deliver, you know, PR doing twice as much net profit, SCI doing twice as much net profit, which we don't think is very far away, because if we are able to unlock 100 million in capital for SCI itself, Puerto Rico already has 100 million and is looking to get to like 150. So they're looking to increase this by 50%. Then we're talking about real capital that can do real damage. So that's how I look at it.
Thank you for that, Jason. Another question from the team chat. Does SYGNUS Credit Investments expect to seek an extension on the Class E preference shares maturing in December 2026? Also, does SCI expect to raise more funding this year to meet higher demand in Jamaica?
Good question. So for 2026, I don't know. To be honest, it all depends, right? Because if we are able to close that transaction with that international financing party, and the structure of that transaction is that, and I'm not giving you an example, right? The structure of that deal is, well, let's take out some of these debt that are maturing in say 1 year, 2 year. So we want a big facility that is 8 years, right? Or 7 years or whatever, tenor, longer tenor. And we need to clean up all of these shorter term maturing facilities, because a lot of the work to just keep going to the market and refinancing and cut out that and get a big long-term facility. Then we take out all of these maturing facilities, right? That are like within 1 or 2 years time, maturity tenor. And then we have that big 7 or 8 year facility that is well structured and as an accordion, so as the business grow, it can expand and grow. And then we don't have to worry about coming to market every minute, and that's a lot of energy. That is I wouldn't say wasted energy, but it's more efficient for us to know, okay, my financing is secure for the next 7-8 years. I can call on this capital and just draw down gradually over time until so I don't have to, so I can just focus on origination and risk management. Makes the job easier and get more bang for the buck for shareholders, right? And it's actually cheaper as well, because each time we go out to raise capital in the market, there's a cost to raising the capital. So that's how I look at. What was the second part of the question? I'm not sure whether or not we're going to extend or not. And in terms of raising new capital, SCI is a financing firm, and we're always in the market raising new capital. It's just that we don't announce or make a lot of noise if it's not a public offer, right? And as you can see, we raise capital without making a lot of noise because we didn't need to do a public offer. But I don't know, whether we will or won't at this stage. Because like I said, we are working on several financing transactions. But in the case that we are, then we'll announce it as usual.
Yes, that covered the whole question. Thanks, Jason. And I suppose the investor that asked the share buyback question, their feedback was, well, their comment was, I appreciate your feedback regarding the share buyback versus the dividend yield. And I agree with you that improving EPS is a better strategy. So I was giving you that comment there. All right, just to clarify a comment made by someone on the team chat. So what's your purpose for, or what is the purpose of the business license? Also, how much funding do you expect to receive from the partnership? And will it go directly to SCI or PRCF? So maybe just clarify the revenue item and sort of how that works and which country, etc.
So I can't answer 99% of the question that was asked, except to say that it is SCI and not PRCF. It has nothing to do with Puerto Rico. So it is SCI proper. And like I said, our philosophy is not to make too much noise. It's just that where we are at the moment, it's appropriate for us to disclose it, because anyone could actually go and find out the information. And then so we disclose that we are doing this, company is registered. I prefer not to say how much money and which country and all of that yet. But we will do so at the appropriate time, and there will be proper press releases and the whole 9 years with the financing partner, of course. So that's all I can say at the moment.
Okay, thank you, Jason. And I think I'll just take final set of questions from either the YouTube chat or actually there's a couple more questions. All right. On time permitting, of course. I'll just ask these very quickly. Or rather, well, there's a comment from an investor on YouTube. I guess I'll read it out. We don't need buyback. Use the money as capital so we raise less money. Jason is taking the right approach. So, and then, so a question here now, what kind of fundraising system do you have in place to get the deployment of capital you need so that you don't run out of dry powder? So maybe you can just clarify that.
Yeah, so the investment manager has an investment banking business, and the investment banking business obviously is charged with raising capital for all the alternative fund companies on the investment management platform that SYGNUS has. And obviously, what the IB team does is collaborate with other investment banking teams. So as you well know, there have been quite a number of different investment banking teams that we have collaborated with. I don't want to call any name and leave out anybody, so I won't call any name. But everybody knows the investment banking team that are in the market, and we have collaborated with quite a number of them very successfully to do some never before done things. So that's the mechanism that we have for raising capital. We go to the board, get approval from the board based on the strategic plan that has been laid out for the firm and the budget that we have for the firm. They say we want to raise X amount of capital, the board approves, and then we hand that over to the investment banking team, who does a roadshow, etc. Or back in the day we used to get underwritten deals. Nowadays that's not really done, but we get commitments from pension funds, institutional investors mainly, but also if it's a public offer, then you have the normal prospectus that is then shared with investors to raise preference shares or debt that is used in Jamaica Stock Exchange. So we can use that venue, or we go to private markets and do a private placement, which is registered with the FSC. But both of them have to be registered with the FSC. And that's how the mechanism works, and it has been working beautifully. But we have added to that, which is to have collaborations with banks. We have some local banking relationships with about $8.5 million US in credit lines. Very tiny drop in the bucket, which is why we have pushed to go internationally to get financing. And the first deal that is being closed is actually going to be bigger than all the credit lines that we have, SCI has combined. And this is a very small transactions for the counterparty. Obviously, our job will be to get that to be multiple times bigger than it is, obviously, because SCI is just going to be a 10-year company now, very young in the grand scheme of things. Then everyone is always going to be cautious. But once we draw down on that and then deliver, then the sky is the limit, because the ability to give us like $100 million is there, right? It's like nothing to do. It's like that's a drop in the bucket for the counterparty. But we have to prove ourselves, and that's the whole thing. And so once we do this obviously we have a model for it, because then we have been approaching other international financing parties who have looked favorably at SCI, given its track record over the last 9.5 years, and say, well, we'll work with you, but these due diligence take extremely long. And you can understand why, right? It's just a 10-year-old company. Like it's just yesterday. But not even high school, SCI don't reach yet at 10 years, at 9.5 years old. So, but the thing is, once you open the door it becomes a revolving door. So that's our mechanism for raising capital, a combination of using local private markets and then obviously international financing market where there's a lot more capital, but it takes like a year and a half, 2 years to open those doors. And then once you open the door, yeah, that's it. You don't need to jump through any more hoops. And that's what we have effectively done. Hopefully, we can announce this. Each quarter come and say the same things. I don't want to say anything more. But just like the repayment of our stage 3 asset, we finally get the cash, right? Finally get the first quarter cash. Hopefully, they can come very shortly and say, yeah, close. We're just waiting on one item to close that, and that will be a monumental moment for SCI, I think, because it would be the first such deal, I think, in the Caribbean. Yeah. So.
Thank you for that. Yeah. Thanks again, Jason, for that clarity. I think we've largely answered and cured some of the uncertainty from investors on the call. And, we appreciate all the insight that you've brought to SCI's financial performance during the period and going forward. I'd like to remind everyone that the recording for this call, as well as the presentation deck, will be available on both the SYGNUS Group website and the YouTube page. I want to give a special thank you to our attendees this afternoon, and thank you for taking the time out to listen to the presentation. If you have any lingering queries, or if you feel like your question was not answered in its completeness, or you have additional questions, feel free to reach out to us via info@sygnusgroup.com or sci@sygnusgroup.com. And I'd like to wish everyone a very productive rest of week. It's a holiday week, so feel free to kick up your feet on a beach or go to church. But either way, have a good rest of the week and goodbye.